We're live, just as live as we can be.
So where are we live at?
Well, we're live on my Facebook and also YouTube.
Okay.
Right now we have zero viewers, and I'm not surprised. This is the first live stream that I have done,
Okay.
and you know, I will have to build up some viewership. Now, I do have a number of followers on Facebook, so some of those guys might drop in,
Okay.
and of course, I will post it to YouTube afterwards, and I'm sure we'll get some views there. Still, what I wanted to talk about today was um, the process of buying your first, well, not necessarily your first home, but are you ready to buy a home? And let me bring up my notes on that. And Sue. Uh, as a realtor, obviously, I'm always in favor of people buying homes, but sometimes you're not quite ready. And one of the big things that people have to be prepared for, everybody thinks about down payment, but what else would we want to have them thinking about in addition to the down payment?
Down payment, safety, once you're in the home, if your refrigerator were to break, do you have enough cash without using credit to go buy another one? What is your credit score? What's your debt load? What are you comfortable with? It's really about the money, in my opinion.
Mm-hmm. Okay.
And then dealing with the right people, to deal with professionals that have been around for a long time, that once you start working with a mortgage professional, they should guide you every step of the way,
Mm-hmm.
to get started. And if you're not quite ready, what is the process to get you ready to buy your first home?
Okay. So, in terms of that, most people think of saving for the down payment, and obviously that is a good thing to do. Other methods of getting the down payment, however, some people get a gift from family members.
Absolutely.
And what are the rules? Obviously, I'm a realtor, not a mortgage
Right.
professional. That's why I'm talking to you. So, what are the ins and outs of getting a gift and other means of accumulating a down payment? So, what do we need to think about there?
So there's three big ways to get your down payment. And a lot depends on what program we're going to go after. You'll hear the words conventional financing, which is Fannie Mae, Freddie Mac. Most people don't really quite understand that. That's just one route to go. And then you have government programs, VA, FHA, USDA. The VA, USDA, depending on if you're a veteran and your entitlement, maybe you don't need a down payment. USDA is where the property is located. So it starts with a conversation about you as a potential brand new homeowner. What are you looking to achieve? And that conversation happens with a mortgage professional. We take the application, which runs through all of your credit history, your assets, where you've worked, what your liability is, how much money do you want to work with. And when you don't have enough money for down payment, there's down payment assistance programs. In Tennessee, it's THDA. There's a lot of lenders out there that will give, if you're doing a government loan, FHA requires a 3.5% down payment. Does not have to be your own money. It could be a grant. It can be a gift. Conventional financing, depending on what program, you may need to prove you have 3% of your own. You've got to have skin in the game there. And then a gift can come in, depending on there's many, many different programs to run after. But it really starts with a conversation, doing a mortgage application, having your tri-merge credit pulled, and then working the plan with a mortgage professional to figure out what is the best option, what's the cheapest option, what option is going to achieve your goals today, 3 years out, 5 years out, etc. It's not just about the transaction to buy the first home, but we even look further down the path 3 years, 5 years, to make sure we pick the right program that's going to accommodate all aspects of the next 3 to 5 years of their life.
Okay. Now, most people, when they think of a down payment, a common figure that comes up is 20% down. And certainly that is a good number if you can swing it. But,
Absolutely.
with the price of houses these days, even a inexpensive house is $250,000.
That's correct.
So we're looking at $50,000 down payment, which is hard for a young couple to, or a young individual, or
Yes.
a group of three, whatever. You've got
Yes.
partners, business partners, whatever kind of partners you got. That's a lot of money. That's a good sized chunk. So
Yes.
what are the
So when they
alternatives to doing the 20% down, and what are the disadvantages of doing less than 20% down?
So when you don't have 20% down, if it's a conventional program, some programs will offer 3% in the conventional arena. A lot of people, and that 3% down comes with mortgage insurance. And there's 5, 6 different mortgage insurance companies out there across the United States. So you're paying your principal and interest. You'll have a mortgage insurance payment that will stay on that mortgage for 5 years, or 78% loan to value. Typically, it'll be 5 years. Or we can do an FHA loan, which requires 3.5% down, and that does not need to be the borrower's own money. That can come in as a gift or a down payment assistance program. In VA, it's all about the entitlement. Maybe you don't need anything down. And then USDA could be another program where the property address is going to be what is going to qualify for USDA financing, which is 100% loan to value. So if the purchase price is 200,000, you're gonna finance 200,000 plus.
Okay.
And there's and that's just to get the down payment.
Mm-hmm. Okay. So you mentioned VA loans. So for the veterans, it's my understanding there are some advantages and some disadvantages for a VA loan. One thing that I've been made aware of is there are origination fees for VA loans. Now, it's my understanding that a VA loan is basically 100% loan, but if certain conditions aren't met, then there would be an origination fee. So can we?
Funding fee. Yeah, it's called a funding fee.
Yeah.
And the funding fee is different according to that veteran's eligibility. So when we're dealing with a veteran, we're going to go into the VA system and we're going to pull their certificate of eligibility. So if they're 100% disabled from the VA, there will not be any funding fee at all. And then it's going to range according to that specific veteran as to what that funding fee, up to 2.25, I believe, is the highest that's out there. It's all about their eligibility, and it's per that veteran.
Okay. So if I'm understanding you correctly, then the only way to really avoid the funding fee is if the veteran happens to be disabled as a result of their service.
That is correct. But we get to put that funding fee right in the loan. It's not cash coming out of pocket.
Mm-hmm. Okay.
Okay.
On the subject of the down payment and before the loan closes, it's also my understanding that a person can fall into certain traps. For example, if they do get a gift from somebody else, or they come into money elsewhere, say they sell a piece of whatever,
Right.
Sell a car, for example, and get $5,000 for the car, whatever. If it's a old beater, obviously, that's a whole other subject. Right. But if they get money somewhere, what are the difficulties on showing that money before the loan closes?
So anytime, let's say we have a borrower that makes $1,000 a month, the rule of thumb is anything that's 20% or greater than that paycheck coming in, we have to explain to the underwriter where that money came from. So if, say, I make $1,000 a month, all of a sudden I have a $5,000 deposit that comes into my checking account, I have to prove where it came from. and if we can't prove it, we don't get to use that money.
Okay.
So it could be a gift now, and then a lot is going to depend on what program are we in. Are we in a conventional loan? That's going to have its own set of rules and guidelines. If it's an FHA loan, we're going to have to prove where that money came from, obtain a gift letter if it were to be a gift, and we have to even show the donor that money came out of their account with a statement or a letter from the bank showing that withdrawal out of their checking account, savings account, wherever it came from, and into the potential borrower's account. It can never be financed. It is okay and appropriate to sell an asset, whether or not it's a car or you had a big garage. You say, well, that's kind of hard to prove, but if there's a large deposit, we absolutely need to prove where that money came from because it's out of the ordinary.
So
okay?
if they
Cannot be
sell a
mattress
car-
money.
Okay.
I'm sorry.
Sorry, I didn't mean to step on you there.
That's okay.
If they were
No
to
mattress
sell a
money's
car-
allowed.
Yeah. So selling a car, then they just need to
Show the bill of
keep a
sale
copy of where they transferred title to the
and
new
transfer title.
owner,
Absolutely.
and then that's fine. But
Right.
money that magically appears is a little bit worrisome.
Right.
Okay.
And when you start the process with a professional mortgage originator, all of that comes into play when you fill out the application, the mortgage professional is reviewing it, and we go pretty much line by line. We're talking about employment. Do we have 2 solid years? Is there a gap in employment? What are the assets? Is the money in that account now? How much do we really need for closing? Or do we have enough? Do we need to make sure when you're ready to go write that purchase offer, we can ask for a seller credit. So, and what that means is if we have I'm going to use a simple number, $100,000, we can use 3% and take that purchase price up to $103,000. So the seller gives us back $3,000 to help offset all the closing costs. If it's a second home, investments 2%. If it's FHA loan, we can ask the seller for a complete 6% credit.
What
So it
about a
depends,
vacation
there's-
home? You're mentioning investment homes. So if someone wanted to buy a vacation home,
Yes. Well, those are a little bit tougher, a little bit more stringent, and typically they wouldn't ask the seller for a credit because those are going to require a little bit more money up front. But if it's a first-time home buyer, or maybe they're a first-time home buyer looking to get in the investment arena, as a lot of young people are trying to do, there are certain requirements, and the seller credits are not as high as compared to a regular conventional loan or a government loan.
so getting into the investment arena, then one way people would do that is to buy a duplex.
Yeah, I wish there were more in Knoxville. Absolutely. I'd buy a fourplex personally. They just don't exist here.
Okay. What's any complications on getting a mortgage for a fourplex?
Zoning, needs to be zoned for that type of property. Typically in the north, coming out of New York, a lot of 2 units, a lot of flats, a lot of 4 units, and it must be zoned accordingly for multifamily use.
Okay, but assuming it's an existing dwelling.
If it's an existing dwelling, a 4 unit will come with a little bit more stringent down payment, and we get to use the rents. The borrower must occupy one of the units, and then we get to use the rents from the other 3. So it reduces the amount of money that's coming out of the borrower's pocket for that mortgage payment. And it's a great advantage to first-time home buyers
So
if
you
they're
mentioned
capable of being a landlord.
Okay. You mentioned a little more stringent down payment requirements. What would we be looking at in down payment on a fourplex?
4 units could be 5% versus 3.5%, up to 10, depending upon credit.
Okay.
Yeah, it's more than a 2 unit.
Okay.
Yeah.
Well, that's not so bad. I was thinking 30 or more.
Oh, no. Because
Okay.
FHA does a lot of 4 unit properties.
Mm-hmm. Okay.
If
Which
you're
is
in an
that's why
area
I'm
with a
talking
lot
to
of,
you again, because I'm
Yes.
not a mortgage professional, and my thinking 30% is obviously a little bit beyond the requirement. So,
Right.
but
Right.
I am
That
kind of
used to be
surprised
the golden rule, 20% down 30 years ago. If you didn't have 20%, chances are you would struggle to get a mortgage. Not today.
Okay. Well, I am kind of surprised that you can get a fourplex for as little as 5% down. So,
It'd be a government loan.
okay. Sorry, I had to have some coffee, but it's tickling my throat a little bit also. Now, you mentioned a good solid 2 years of employment, and I am under the impression that a W-2 job is much more desirable than a 1099 job in terms of getting a mortgage. And a 1099 does require flat out 2 years on the job, if I understand correctly.
Not necessarily.
Okay. Guide us
Okay.
through that.
So if you're a 1099, you're an independent contractor, self-employed. There are different programs available to you because if you're self-employed, you're taking the benefits of not paying the IRS because there's so many deductions that you can take when you file your tax returns. However, all of those deductions don't get reverted back into income when you apply for a mortgage. So, but there are programs out there. We can use bank statements. We can use an audited P&L from a CPA, and that would generate the income that would be used for that program. Those are much higher rates, a little bit more risk, but they're available out there.
Okay. Now, as of recording today, I'm thinking the rate's like what, 7.4% average, and of course I understand it depends on your credit and all that, but
it depends on your loan to value, what your program is, what your FICO score is. Everybody wants to know, okay, today's 7%. Okay, let's go. Well, if that's the national average and you have a 500 FICO score, you're not going to be anywhere close to 7%. If you're self-employed, putting 10% down using a bank statement program, your rate is going to be closer to 8-9%. If you're going to buy a property as your LLC because it's a flip, we want to buy it, we're going to gut it, we're going to remodel it, we're going to turn around and sell it. We're not going to use our personal income to do that. We're going to use company income. Again, that rate is significantly higher. So I tried the other day to put together an email for someone like, what's your best vacation home pricing and programs? And because I have so many lenders to go to, I was like, you know what? This is just way overwhelming. Just way too, like, I could write for days and days and days. I'm like 10% down and rate's going to be dependent upon FICO score. Like, all of that task was just for that one sentence. So yeah, it's overwhelming. And as a professional, 23 years in this crazy industry, I'm a broker. I like having the option versus just working for one company with one set of programs. I do a lot of business because I can offer things that banks cannot offer. As an example, if you're a veteran and you want to build a one-time construction and get a one-time construction mortgage, some banks will tell you it does not exist. It does exist.
Okay.
That bank just doesn't offer it. Or that bank, when you want to build, they're going to make you jump through a million hoops that most people will not make you jump through.
Okay.
It comes down to having the right mortgage professional in your court with the right realtor and title company and working with the correct investor for that mortgage.
I am kind of surprised to hear that you have programs available for flips. I have worked with some people doing flips in the past, and every time they've used a hard money lender. So
Yeah, they don't need to go hard money lender any longer. We can write the loan as the LLC. I've got a company out of Charlotte that I work with. They're phenomenal to work with. You have to have the construction done. There's some time constraints. So, and they look at how much, and these are pretty interesting too. And they're pretty cool. So, and it's kind of twofold if you're going to deal with a flip. So we've got the purchase price of what we want to buy to remodel, to turn around and flip it. So that would, let's say we're going to make a purchase of 100,000. So investor may say, okay, I want 20% down on the 100,000. And then we submit plans and specs saying, okay, now my construction is going to be 200,000. And then they're going to look at if it's major or minor, everything that's going to be done. And then they're going to come back and say, okay, now I want 10 or 20% down. And we're going to, either give you the money all up front, or, we'll create a schedule for you, but you have to be done in 9 months or 12 months. And if you're not, there's a pretty stiff penalty. But we're writing those every day so that people don't need to use their own funds any longer.
Somebody that's not got a flip done in 9 months ain't working too hard.
I know.
I
I drive by a condo complex every day, and there's at least 4 construction projects going on in there right now. And I know they're all flips.
Mm-hmm. Okay.
Yeah.
Well, that is interesting. And I've got a few folks that do flips. So I'll talk to them and see if they're still using hard money, or if they've built up enough funds on their own, or if they need to come see you.
Yeah. So, I'd love to help them.
We did cover closing costs a little bit there. And of course, that's going to be required in addition to the down payment and moving expenses. And you mentioned fixes like a dishwasher breaking or something like that. So it's not just the down payment either. And of course, there's other, when people get their quote on their mortgage, they're getting a principal and interest payment. And most people think, well, that's my payment. But, you got to include the property tax. And you got to include the insurance on the property, which is going up, especially in some of the states. It's not so bad here in Tennessee yet, but it's my understanding Florida has gone totally nuts on property insurance. So other things do have to be considered, and you need a little bit of extra funds there to cover more than just the down payment. Now, another thing that I've got on my notes here is debt, and you briefly touched on that, debt to income ratio. And I assume that the debt to income ratio is relatively independent of the credit score, or will they allow a higher ratio with a higher credit score?
So and it's program based. So I want to specify, like, if it's conventional or FHA, USDA, VA, everybody has their own certain requirements. So if you're an 800 FICO score, anything above 740, let me just say that anything above a 740 in the mortgage world you're going to get the best of the best. And some programs allow a 45% debt to income ratio. So that means your mortgage with taxes and insurance and all your other debt load can be 45% of your gross income. If you're above a 740 and you have reserves in the bank, let's say you have 6 months worth of mortgage payments that after closing and everything's paid is still going to be sitting out there, sometimes our systems will allow us to tick up a little bit. VA will allow you the greatest debt to income ratio of all in what I've seen in my 23 years of writing mortgages or being involved in the mortgage process.
Okay.
But we don't want to put somebody in a home that we know that they can't even make their first mortgage payment.
Well, back in 2008, that was what.
Oh yeah, that happened.
There's all those dadgum loans they were putting out there. No doc, tell us how much you make and we'll believe you. and they were just writing loans left and right to people that could not afford them.
That's
And
right.
as a result, there was a massive number of foreclosures. And this is one thing that annoys the heck out of me. I see a lot of people talking about the foreclosure crisis that we're about to enter. I can't see it because the simple fact is that right now the delinquency rate is about 1.8% on mortgages, or at least the last time I looked at the numbers. And 1.8%, and that's only 30 days late. When you get to 60 and 90 days late, it's even less.
Right.
That is not going to generate a foreclosure crisis. So
No, not at all.
That,
And the servicers over the years, going through '08, going through the Dodd-Frank, all the new requirements mortgage professionals and realtors go through with the updates of laws and being an advocate for everybody. Just if someone's in trouble, pick up the phone, call your servicer, communicate up front. They did that during COVID, helped a lot of people out. Just communicate. I mean, unfortunately, things happen in life, but pick up the phone, and most of the time they will absolutely work with somebody.
As I say, it shouldn't be much of a problem right now, but I'm assuming short sales do still occasionally happen, or not so much anymore.
I haven't seen a short sale in a very long time. I'm sure they're still out there. I've heard a lot of buzz recently about like tax sales with the investors and flip companies, trying to go in and buy out something where they haven't paid their taxes. That is more state specific.
Yeah.
It's all state requirements or local government requirements for those kind of things. But I haven't heard any like derogatory, I would classify that as like derogatory mortgage involvement in a very long time.
Okay. Another thing that I've got on my notes here is job stability. If that's questionable, then people should watch out for being ready to buy a home. And
yes,
I have heard there have been instances. Now, first of all, one thing that most people don't seem to understand is that, like the day before closing, the mortgage company will go and pull their credit and verify employment again.
right.
And
yes.
there have been a number.
And there's been a number of issues. Yes.
Yeah. So.
Yes. And that's where a good mortgage professional is going to tell that borrower, hey, when before closing docs go out, there's someone that's calling your employer to validate you're still employed, and there'll be a soft credit pull. And I tell all my borrowers, as soon as you're out there shopping for your home, your credit, no more credit. Okay. The house that I'm in, I'm the crazy person that built a house up the street, drove out, they hadn't started it, and there was a big for sale sign on the corner house that was just complete. And I'm like, what happened? Like, what? What? The house is like mine. And they're like, no, you don't want that house. There's already 2 contracts on it. I'm like, I don't care. I can close next week. And so those people, unfortunately, bought a new car. So in the middle of their construction, bought the car, didn't communicate, and therefore they no longer qualified for their mortgage. And that happens. I know you want a house full of brand new furniture. Okay. Can we get you closed first? Let's get the house, or you're going to have furniture and no place to put it.
I sold a house to a guy last year, a very nice house. It was $750, and obviously he has a good income and a good credit score. But even with that, I was cautioning him about buying crap, and it didn't hurt him. But he didn't listen to me.
Don't want the Maserati to show up.
A pair of Italian leather boots. I don't know. I think he paid like $1,200 for the boots. And put it on his credit card, of course. So, but like I say, he had the money and the credit to back it up. But still, those are the kind of things you don't want to be doing before closing.
Absolutely. Anything out of the ordinary, the underwriter will have the right to ask. You're excited to go to closing. You put an additional $10,000 on your credit card. They're going to want to know what you bought, because even though we've proven where the down payment is coming in, did you automatically go ahead and decide to finance that down payment? You just lost your mortgage. You cannot finance your down payment. in the process.
Hmm. But I guess we can close out here, with getting back to the job situation one short minute. Although you personally want to be careful about your job situation when applying for a mortgage, I was looking at the BLS report and the ADP report today, and the jobs market is still very strong. So
Very strong.
yeah, I don't think we're, all these people that have been hollering doom and gloom for the last 2.5 years, they're just hollering doom and gloom. And I don't really, I think
that's why inflation won't stop. People has money and they're spending it.
Mm-hmm. Roger
Yeah.
that.
Yeah.
Well, Lisa, I appreciate your time. I know you're busy, and I'm sure you want to get back to it. And of course, this is Friday afternoon, so you may want
I
to kick back
appreciate
and
it.
relax a little bit.
It's been a ton of fun, and it's a process. But if you're with the right people, educated, I like to hold my clients' hands every step of the way with a good realtor, mortgage professional, insurance agent, home inspector. It takes a network, and
Absolutely.
those of us have, and it all works. And
I do want to add one more thing you just made me think of, and that is, for goodness sakes, if you're buying a home, use a local mortgage broker. Do not either go to an internet mortgage broker or an out-of-state bank. I don't care if you're out of state. I just had a deal fall through because the buyers are from up in Pennsylvania, and the mortgage company they were using was their local bank that they've dealt with for years up there. And the appraisal came in stupid low. It was a little over a $500,000 property. The appraisal came in at $240,000. And the bank would not look at another appraiser. Said, nope, that's it. It's gone. We'll see you later. So it's gone. So, but my point being, anytime I've had any difficulty with a mortgage, it's been because it was not a local mortgage company here doing the work. So, yeah, that's the last thing I got to say about that.
Yeah.
As Forrest.
It's usually the first two or if you do a Google search, it's usually, and it'll say sponsored.
Mm-hmm.
I won't mention any names.
Yeah, we all
know.
But
it's always those top three. And even if you're a veteran, if it has a VA in the name, may not be your best choice.
Yeah. Yeah, it's not.
You got to do your due diligence. And that's why they work with great realtors like yourself, who put them in touch with great mortgage people to make sure if it's the house that you want to buy, that we get you in there.
Mm-hmm. Okay. Well, very good. We'll have to meet up here one of these afternoons and have a cup of coffee again. But
sounds great.
I appreciate you being on. And I'm
and
sure I'll find something else I want to talk to you about in a couple of weeks.
Okay. Sounds great.
Have a good evening.
Because it's all about the veterans in the month of May. So there's a big push right now to help more veterans.
Okay.
All right.
I will put the word out for that.
Okay. All right.
Thanks
Thank
a lot.
you. All right.
See you
Have
later.
a good weekend. Thanks, Ed. Bye-bye.